The dog days of summer meet a busy news week, and the markets take it all in stride. This is Bloomberg Wall Street Week. I'm David Westin. This week, contributor Steve Rattner of Willett Advisors on whether we are witnessing a fundamental shift of power back toward workers.
On an aggregate basis, households are in extraordinarily good shape, and many people don't have to go back to work, and they're choosing not to.
And Larry Summers of Harvard on why he says the Biden administration's push for lower gas prices is problematic.
I think there's no more important price to increase in the American economy than the price of carbon-based fuels.
Considering that it is the middle of August, there was a lot of news this week. News that at some other time might have gotten the markets going, with a $1.2 trillion infrastructure bill approved by the Senate.
America, this is how we truly build back better. This bill is going to put people to work, modernizing our roads and our highways and our bridges.
While the Delta variant continued to grow, putting more of us in the hospital.
We've seen the number of hospitalized patients with COVID in Trinity Health more than triple and almost quadruple since early July.
Investors watched those CPI numbers with trepidation on Wednesday, but they seem to calm the markets in their slowing down a bit.
Double-digit gains in wages don't help if you've still got double-digit gains in prices, particularly in the things that you need most.
And if all that weren't enough, we had the governor of New York do an abrupt about-face and announce his resignation in the face of scandal.
Given the circumstances, the best way I can help now is if I step aside and let government get back to governing. And therefore, that's what I'll do. My resignation will be effective in 14 days.
And how did the markets react? Well, despite all the news, they pretty much shrugged off the events of the week, with the S&P 500 higher on the week, but really just by a little bit. And small caps took a bit of a hit, falling 1%. The 10-year, in the meanwhile, the yield fell below 1.3 after a report showed consumer sentiment fell to the lowest level in nearly a decade. To take us through the week in the markets, welcome now Nancy Davis. She's Chief Investment Officer and Managing Partner at Quadratic Capital Management, and Saira Malik, Chief Investment Officer for Equities at Nuveen. So, Saira, let me start with you on the equity side. Despite all the news that came out, and there was some up and down, the equity market just kept going up, although not quite as fast as it had.
Equity markets and bond markets definitely became disconnected this week. This is around the great debate around economic data and also inflation. We saw cooler CPI data, hotter PPI data. Our view is that the cooler CPI data wins out because the factors driving that down are more permanent, such as lower used car prices and also a shift of spending from goods to services. While the PPI data is hotter, but that's around the one-time reopening. Other data points we watched this week were the infrastructure package, $550 billion in new spending. That's good for industrials. And then, of course, consumer sentiment coming in at the lowest level in a decade. It is Friday the 13th, but we're not all doomed. If you look at consumer sentiment, it's not always tied to consumer spending. We saw low numbers in the fourth quarter of 2020, while equity markets still produced positive returns. We're watching economic data like the Conference Board data, which remains over one standard deviation above its mean.
I actually saw a Bloomberg chart today suggesting that the markets often go up on Friday the 13th. This is the only one this year, though, I'm happy to say. Nancy, let's turn to you because you've made something of a name for yourself in investing in and around inflation, really knowing how to take this into account as an investor. What do you make of those CPI and PPI numbers, which seem to go a bit in different directions this week?
Well, I think if you look at the long-term trend, if we start at, say, the first quarter of 2021, the 10-year yield was 175, and then we've had 4 CPI prints well above the 2% target from the Fed. We had 4.2 first, then 5, then 2 5.4 prints, and you would kind of scratch your head, and if you had a crystal ball at the start of Q2 and you knew the CPI prints were going to come in that much higher than 2%, what would most rational people do? You would sell bonds because you would think yields would be going higher, but it's opposite day in the markets. and yields have done nothing but go lower with all these higher CPI prints. So I think there's definitely something screwy going on in the markets where nobody believes inflation is actually going to be here, because why would you be locking up your capital? To your point, David, that the 10-year is under 1.3% right now, that doesn't make any sense if you actually believe that inflation is coming.
Yeah, and we had any number of experts saying sell bonds, sell bonds, sell bonds, because the yield is just going to go down as a practical matter. But Saira, you're an equities person, not a bond person. But how much of the support of the equities markets that we're seing is exactly because of what Nancy was talking about? Because yields actually have been very tame. People were talking about 2.0 I'm talking about on the 10-year.
I mean, that's definitely makes equities look more attractive. From an equity portfolio point of view, we're definitely saying you need to become more selective here. First of all, you need to look for those companies that have the pricing power to overcome these inflationary costs. We're also seeing profit margins at about decade highs for companies. So these companies also need to be able to raise prices in order to drive their margins higher. Areas that we think are attractive are actually small caps. They're now trading at the largest discount to large caps that we've seen since September 2020. They're back at valuation levels of January. They tend to do well in periods of rising inflation and interest rates. And we like industrials because as that infrastructure package kicks in, industrials will have that cyclical tailwind behind them to help them grow their businesses and increase their profit margins.
Well, and it's not just the infrastructure package. We now have the Democrats in the Senate at least saying would like another 3.5% incremental spending in that sort of second wave, the Build Back Better plan, as President Biden calls it. So Saira, if in fact that comes to pass, and forget the 3.5, suppose it's just 2 or 2.5, what does that mean potentially for investors?
I mean, for investors, I think it means we have more confidence in economic growth going forward. If you look at 2022, third year past the recession, market returns actually tend to be pretty strong. We see high single-digit earnings growth next year. That's not recessionary levels. It's not where you would be for a bear market. We think that drives markets higher rather than valuations, and that's supported by economic growth. Now, we do have two headwinds next year. One is how are we going to pay for that infrastructure and all that spending? Probably higher taxes. That's going to negatively impact that earnings growth number. And also, we need to worry about taper timing. The Fed's been taking baby steps towards taper timing. We think they're watching August payroll data. If that looks as high as July data, we think the Fed could announce tapering in September and start tapering in early 2022. But as long as the yield curve doesn't flatten, we think that markets can remain with positive returns even through tapering and higher interest rates.
So Nancy, I don't want to misquote you, but I think you said the markets were a little bit screwy, I think was the word you used. Now, given what the CPI numbers have been being and what the year-over-year inflation is, despite the fact people don't think it's going to come, how much of that do you think maybe because of the Delta variant, that people are really subdued? And we had really stunning numbers at the end of the week on the consumer confidence out of the University of Michigan, the lowest, I think, in 11 years. How much of that is really constraining some of what we otherwise might have with consumer spending?
Well, I think to Sarah's point, the yield curve is the most important measure to be watching. It's very forward-looking. And since the Fed's June FOMC meeting, we've had the largest flattening in the forward yield curve since the financial crisis. And that should be ringing the alert for equity and credit investors, because corporates are priced to perfection, right? Everybody's expecting growth. Everybody's expecting earnings per share. But what if we actually have higher labor costs or shortages of goods and services or shipping delays? All those things, the yield curve is expecting has had a massive flattening. And that's also because the market has priced in the Fed hiking rates. And so we really see it as an opportunity. And that's what we've been taking advantage of in the iVol ETF to express a steeper yield curve because we think that forward flattening has been overdone because it doesn't make any sense with all these high CPI prints that people are willing to buy long-dated government bond duration and not get any return for their capital.
So Saira, Nancy says that the yield curve really is so important to what we have. Is that right? And if so, what does it tell us about what the Fed is likely to do given the numbers that they're seeing right now? Because we were thinking they're heading toward tapering pretty soon. This week, there's some hesitation about that. I think maybe it might be a little bit longer before they taper.
I agree with Nancy that the yield curve is the key. Oh, go ahead, Nancy.
No, Saira, go ahead.
I was going to say, I really do feel like the yield curve is the key, as Nancy mentions, in terms of what it reflects going forward. And while we are past peak economic growth, the economic data points still remain very expansionary. Inflation data, from our point of view, is telling us that while it's likely to end up at higher levels than it was pre-pandemic, we don't think inflation is getting out of control. The key factor to watch there is wage inflation. Only in leisure and hospitality sectors are we at elevated levels beyond pre-pandemic levels when it comes to inflation. The rest of wages actually look quite tame to us for now. So, we think our view is that strong economic data remains in expansionary territory going forward. Inflation remains fairly mild, and therefore you don't remain in a situation where the yield curve flattens. And the Fed can taper and raise rates, tapering in early 2022 and raise rates likely in 2023.
Saira, I'm sorry, Nancy, what were you going to say?
I was going to say that an upward sloping yield curve is a very healthy sign for financial markets. If you think about what our banking system, the way it operates, is lenders borrow short term, typically in the repo market or the commercial paper market, and they make long-term loans to small businesses in Main Street. So I do think investors really need to keep an eye on what's going on in the rates market to get indications about what investors are thinking, because that upward sloping yield curve is actually a very, very healthy sign to get all the capital that's in Wall Street out to Main Street. And that's what we try to take advantage of in our IVOL ETF, is to really give access to that market, because it is, where lenders lend money. That's what, the term structure of interest rates, policy rates are set by the central bank, by the Fed, but where lenders lend money in the future is largely a result of growth expectations and inflation expectations. So we think a healthy upward sloping yield curve would actually be a really positive sign for the U.S. economy.
Okay, thank you so much to both of you. That's Saira Malik of Nuveen and Nancy Davis of Quadratic Capital Management. Great to have you with us on Wall Street Week. Coming up, Disney comes roaring back from COVID, but was it old-fashioned theme parks or was it the high-tech streaming? We talk with media executive and entrepreneur Michael Wolff of Activate. That's coming up next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Streaming giants like Netflix and Disney were among the few winners during the pandemic as lockdowns forced people to stay home. But Netflix earnings last month raised some questions, some initial questions at least, about whether it was just a blip or a long-term trend. This week, Disney showed that it could keep the momentum going with better than expected subscriber growth for its Disney Plus streaming service. Michael Wolff has served as president and COO of MTV, on the board of Yahoo, and is the co-founder and CEO of Activate, which advises tech and media companies. Michael, great to have you, the guru of media and tech. So first of all, let's start with Disney. And a basic question, at this point, as an investor, do you invest in Disney as a tech stock or a media stock? Because as you and I both know, the multiple is quite different.
Yeah, I mean, when you think about what investors are excited about, they're starting to look at, yes, 116 million in total subscribers globally, which compares to Netflix at 200 million. So they're getting up there. If you look historically, Disney was trading in the same neighborhood as Netflix and Amazon, really in the 50s. Going forward, it looks like they're trading at around 37. And some of that just has questions about their ability to execute. With Bob Chapek in place, who Bob is incredibly exquisite at execution, there's a lot of upside in the stock. If they were to hit the same kind of multiples as Netflix and Amazon, you're talking between 30 to 50% increase in shareholder value for this company.
But Michael, that raises the question of there's a lot to the Disney company beyond streaming. They have the theme parks, they have the cruise ships, they have a television network after all, things like that. Is that ballast that sort of rights the ship if it might go off, or does it limit their upside? Because when you talk about Netflix, for example, they have pretty much all their eggs in one basket, which is the tech basket.
Right. Disney has a great deal more to play with and a great deal more to underwrite their risk from streaming. The fact is that the parks are back, Delta or no doubt Delta, we should see a stunning recovery from in the parks. A lot of other places in their business are doing well. But let's remember, compared to Netflix, they have licensing and merchandising. Yes, they have the theme parks. They can create other shows. They can create other networks. So they're fundamentally in a better position than Netflix. In a lot of ways, they're similar to Amazon, which is streaming is only part of the picture and the revenue mix.
So we've been talking about Netflix and Amazon and Disney. There are some other players out there, right? We have people like Comcast, for example. We have Viacom, CBS. We got other players. Discovery, goodness knows, which is going through a big transaction. So what is the future of the business overall? What sort of consolidation might we see? After all, I think Disney got there in part because Bob Iger really bellied up to the bar and bought all those assets from Fox.
Well, he bought the assets from Fox, but he also bought Lucasfilm with Star Wars. He bought Marvel with the entire Marvel cinematic universe. And so you see, what we're going to see is a continued and consolidation frenzy among the major media companies. If you look over time, what's happened is every new wave of technology has driven changes in the composition of this industry, but it's actually increased revenue in the industry. So some of the things that are driving it is the growth of streaming, but it's also some others. One is the decline in cable, and cable's been the driver of revenue growth and profitability in all these companies. Increased rise of connected TV. Within a couple of years, practically every American home will have a connected TV, whether it's a Roku or it's a Vizio. And but also it's this need to compete against Amazon and Google and Facebook and Apple. And so we're going to see a lot more consolidation. Each of these companies, one way or the other, is going to have their own streaming services. I'm very upbeat about what Warner Discovery will be able to do. I believe that between Discovery Plus and HBO Max, they will also get to 200 million subscribers worldwide.
So, Michael, much or all the consolidation thus far, I would say, is within sort of the media space. And even today, there's talk about CBS, for example, and Comcast. Should they get together at some point? What about even outside of that space? People say maybe Apple should buy CBS or buy Comcast or something. Do you expect it to go beyond just the four corners of the media world as they consolidate in the streaming world?
Yes. First of all, we see Amazon's $8 billion acquisition of MGM, and once approved, it gives Apple access to a massive library historically of shows and also the ability to produce going forward. But I expect that every one of the technology companies will, one way or the other, find themselves into production, either television or films. And the result of that is they're not going to be able to build these services just on new production. They're going to build a lot of it on libraries. And if you also look at the amount of money that each of these companies are spending, Apple TV Plus is costing billions of dollars a year. It is really a part of the entire Apple ecosystem and supports so many other things. So we will see mergers between these companies. And given the valuations, once you move away from Disney, they're easy to pick up. In some cases, there are a day's volatility of a stock in terms of being able to buy these companies.
Yeah, no question they could afford them, but at some point, don't you have to get back to the fundamentals, things like earnings per share and dilution? I mean, take an Apple, just to pick on Apple for a second, they have enormous margins. If they go into the production business of movies, you know that business, I know the business, boy, your margins are not that great necessarily.
Well, they're already in the business, and it's so small. It's just not significant to their overall profitability. But it's also key to their App Store and service revenues, which have been so important, especially as the sale of devices seems to slow down. So I think that they're in a better situation than any of the media companies, which are today trading at multiples like 10, and do have challenges in terms of being able to spend operating money in terms of ramping up production. That hasn't stopped them. I mean, Viacom CBS just did a $900 million deal with the creators of South Park to do a whole new set of series. Everywhere, every which way, we're going to see more money spent on the production of entertainment.
But Michael, you have the history in this business. Sooner or later, doesn't the money go to the talent? I mean, let's talk about Scarlett Johansson, for example. She's not a one-off here. A lot of people are going to be saying, wait a second, I'd like a piece of that streaming action.
The streaming action, it's going to go to the talent, but also it's going to go to the people that are producers of programming. And so Hello Sunshine, Reese Witherspoon's company, which is behind shows like Big Little Lies and Apple TV's The Morning Show, just sold for close to $1 billion to a new company, ironically owned by Kevin Mayer, the former head of business development and strategy for Disney, and Tom Staggs was the former COO of Disney. So we're going to see a lot more, and it's going to be other production companies that are going to be for sale. A24 is rumored, Lionsgate. So it's going to go to the talent, but it's also going to go to the content owners.
And I should say, I worked with Tom Staggs and Kevin Mayer at Disney, so I know them. They're very able people. And let's be clear, Michael, when I talk about talent, I'm including writer-producers, because if you know TV or movies, that really is where a lot of talent is. Thank you so much.
David, today you're talent also.
No,
so,
I'm not. No, anybody around here will tell you I'm not talent. Thank you so much. It's great to have you with us. That's Michael Wolff of Activate. Coming up, we take a look at the week ahead on global Wall Street. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It's time now to take a look at next week on global Wall Street.
Thanks, David. China's monthly data deluge will be key for investors this week as the spread of the Delta variant is set to drag on growth amid intensifying price pressures. Both Goldman and JP Morgan have cut their outlooks for China's growth this year, predicting more easing from the PBOC. Tencent's earnings will also be in focus, but are likely to be overshadowed by the regulatory onslaught that's knocked some 40% off the stock price from its January peak. Also on the docket, Japanese second quarter GDP, Aussie July jobs numbers, and a likely lift off from the RBNZ when New Zealand's central bank holds its monthly meeting. Danny?
Thanks, Juliet. Starting on Monday, Britons who are fully vaccinated no longer have to quarantine if they've come into contact with someone who tested positive for COVID. We also get a raft of data in the week, including inflation from the UK and Eurozone. Romain?
Thanks, Danny. There's going to be a lot of focus next week on the supply chain disruptions and the price pressures being put on companies and consumers. Home Depot, Macy's, TJX, Target, and Walmart are the big retailers slated to report earnings. Executives will face questions on how they're preparing for that upcoming holiday shopping season with inventories low, shipping ports clogged, and input and labor costs elevated. New government data out on U.S. retail sales will also add to that narrative. Those numbers out on Tuesday, they're expected to show a month-to-month decline in purchases. And finally, look for an update on the chip shortage. Earnings from Analog Devices, Applied Materials, and NVIDIA slated for the week. David?
Thanks to Juliet, Danny, and Romain. Coming up, the enigma that is the labor market. Is it possible that we are seeing a shift in power back toward the labor side of the ledger? We ask Steve Rattner of Willett Advisors.
People can't spend their savings forever. At some point, most Americans need to go back to work, and they will have to go back to work.
This is Wall Street Week on Bloomberg. The pandemic disrupted employment around the world, and as the economy recovers, we can't assume that we'll go back to working the way we did before. We've added millions of jobs since the low point, but the unemployment rate in the U.S. is still above 5%. And taken as a proportion of the population, employment is actually close to a 4-decade low.
On one hand, the labor supply seems tight. On the other hand, when you judge by the number of jobs we're short from where we were in February 2020, or the unemployment rate still seems like there's quite a bit of slack in the U.S. labor market.
It's a trend that's affecting companies from services to Wall Street. A range of firms are raising salaries and paying bonuses, while others are offering perks, like a free Peloton bike or an all-expenses-paid vacation.
Compensation is important, and we've always, I think, been a leader in that area.
Inflation and the labor market go hand in hand.
Higher prices lead workers to ask for raises. And as we get back toward full employment, employers may have no choice but to pay them.
We're within 9 months or a year, certainly, maybe less than that, of getting to full employment.
And now the pandemic has added a new dimension to the traditional back and forth over pay and hours. Now there's the option of working from home as well. Bloomberg's John Author says it wouldn't be the first time that a pandemic strengthened the hand of labor at the expense of capital.
One of the reasonable lessons from history about pandemics, not that we've had too many pandemics that are exactly like this one, was that it does tend to strengthen the hands of labor compared to capital.
A University of Chicago study suggests that if employers try to make employees work from home 5 days a week, more than a third of their workforce may just quit.
Physical presence, I think, is important for people, but also the pandemic has taught us that we can be quite flexible.
Unions are another part of the equation. The percentage of unionized workers in the private sector has been falling for years. It's now just above 10%. But the Biden administration has put organized labor at the center of its programs, from climate to infrastructure.
Front and center will be the workers who have built the middle class. They're our secret weapon in winning this global race.
Steve Rattner has spent his professional career looking at the balance between labor and capital, first as a successful banker on Wall Street, then as leading the efforts to renegotiate and restructure the auto industry under President Obama, and now as chairman and CEO of Willett Advisors, which invests the personal and philanthropic assets of Michael Bloomberg, the founder and principal shareholder of our parent company. Steve, thank you so much for being back on Wall Street Week. So let me ask you how we can have what we have right now in the labor industry. We have more than 4 million new jobs we've created in the last 6 months. We have, at the same time, a record number of job openings, and yet we have the lowest percentage of people actually employed of the overall population in something like 40 years.
David, as you said, I have been watching this for 40 years, actually, as it happens myself. And I've never seen anything quite like it. I think this will be enormous amount of grist for the mill of economists to study in the years going forward. But essentially, yes, there's strong demand for labor. The country, at least so far, has been reopening, in large part thanks to the federal government and all the stimulus. And yet a large number of Americans are reluctant to go back to work for a variety of reasons. There's a lot of polling data on this. Some of it is health concerns. Some of it is the fact that they've decided simply to leave the labor force and retire. Some of it is the expanded unemployment benefits that actually pay some people more for not working than they were getting working. And a lot of it, though, is the fact that people's balance sheets, the household balance sheets, are in extraordinarily good shape. You had an enormous amount of financial support from the federal government last year. Total income earned by Americans, including federal transfer payments, was actually $1 trillion above what would normally have occurred last year. And households spent about $1 trillion less than they would normally spend last year. And so people don't have to go back to work because in many cases, and obviously I'm giving you broad generalizations, there are plenty of exceptions in both directions, but on an aggregate basis, households are in extraordinarily good shape and many people don't have to go back to work and they're choosing not to.
Before this pandemic, I think some people might have said it's sort of a buyer's market. If we make the employer the buyer, that basically they can largely dictate the term. The bargaining position was really stronger for the employer. Is it possible that's shifted because of the pandemic?
Well, I think it's shifted for the moment. I'm not sure it's shifted forever. It's shifted for the moment for the reasons that I just described, that people, I think in general, again, broad generalizations, people have the wherewithal to not go back to work. And so they are able to a greater degree than they have in the past, as you suggest, dictate the terms under which they're going to go back to work. That should be a somewhat transitory effect. People can't spend their savings forever. At some point, most Americans need to go back to work and they will have to go back to work. But in the short run, what's going on, as you well know, and everybody knows, is that employers are raising pay, especially for people at the bottom, which is in many ways welcome news, to try to get them to come back to work. And as you also said, we have created a lot of new jobs. So slowly but surely, they are coming back. And I would expect that trend to continue over time.
It's early going, and you know the dangers better than I of trying to make long-term projections off of single data points. At the same time, what do you think about the work from home phenomenon? Has it injected into the negotiation between labor and management a new element where it used to be mainly about pay and hours? Now we have where we're going to be working from. We see a lot of people saying, you know what, I'm willing to go back, but only if I can work from home.
There's no question, and again, the polling data brings a lot of this out. There's no question that the work from home and just a lot of things that relate to the pandemic, this extraordinary once-in-a-century event, have changed the way people think about many of these things. And yes, there's no question from the data that people are putting a greater value on the ability to work from home. And if they're, for many of them, if they're choosing between two jobs, one of which they're allowed to work from home, one of which they're not, they're more likely to choose the one in which they can work from home. But that's okay for employers too. For many of these people, you can work from home. But as I said, I do think in the fullness of time, the luxury that people have today, which I'm fine with and thrilled by, of being able to make these kinds of choices will diminish, and people are going to be in a position where they're going to need to work, and the jobs will be what the jobs are. Some of them can be done remotely, but many of them can't.
Steve, let's inject one other element into this that you know well, and that's organized labor. Certainly you dealt with that when you restructured the auto industry. President Biden and his administration have made a priority of really advancing the cause for organized labor, which, if had happened, would reverse something that's been going on for some time. We're down to just over 10%, I think, of the private workforce that's organized right now under a union. Is it possible for the Biden administration to turn that around?
I think they can make some difference. There's no question that the balance of power had shifted over the last 20, 30, 40 years away from organized labor and to employers. Labor's share of profits in the economy had dropped to a relatively low level. Corporate profits have been incredibly strong. Real wages had not done particularly well. And so, yes, it is both necessary and possible to begin to shift that around. I think you want to be, and I'm all for organized labor, but I think there are a couple of things you want to be careful about. Number one, something we saw in the auto industry is that you want organized labor to focus on pay, not on job restrictions, where, you know, General Motors had 300 different job categories under its collective bargaining agreements, which we eliminated virtually all of them so that people could actually work more flexibly and more productively. And secondly, you have to be a little bit careful about what I'll call the tradable sector, basically manufacturing, things that we export, where we are globally competitive. And if labor costs here get too high, what's simply going to happen is jobs are going to go somewhere else. And some of that has happened in the auto industry. The share of auto jobs that have moved to Mexico has been growing because Mexican labor is very productive and much, much cheaper. And so you have to be careful about that too. But within those parameters, there are things that we can and should do to increase the power of organized labor. And I commend the Biden administration for thinking about that.
Talk as an investor. I mean, you're a long-term investor. If you knew, and we certainly don't know, if you knew that, in fact, there was a shift going on in the relative importance, strength of labor versus capital, how would it change your investment decisions, if at all?
One of the interesting things about the current situation is that it's not so much a shift from capital to labor. They're both actually winning. Labor is winning because pay is going up rather quickly, as I said, especially for people closer to the bottom. But actually, capital is winning too, because the fact that there aren't as many jobs coming back as we had before, but our output is close to where it was before the pandemic, means productivity is increasing. And so what you're seeing in the second quarter earnings numbers that have been coming out is that companies have done a surprisingly good job of maintaining their profit margins, even as they're paying people more, because they're simply using fewer people to do the same thing. Now, at some point, if everybody decides they want to go back to work, that creates a different kind of problem. But for right now, we're in a kind of happy spot where labor and capital are actually both winning.
Insofar as labor starts demanding pay raises and we start having to increase that, what does it do to margins? Does it affect what sectors or what areas you invest in because they might be more margin sensitive?
Well, sure. As I said, sure. There's no question that paying people more affects margins, and so you look at a lot of the companies in the hospitality area, the Amazons of the world, companies that use huge amount, Walmart, Target, use huge amounts of relatively low cost labor. This will put pressure on their margins, and it is something that we think about and need to think about. But as I said, for the moment, as you look at the earnings reports that are coming out now, these companies have been very, very successful at simply doing more or as much with fewer people. And so at the end of the day, their corporate profit margins have stayed quite quite robust. It can't go on like that forever, but for the moment, it is.
Okay, Steve, thank you so much. I always delight to have you on Wall Street Week. That's Steve Rattner. He's the chairman and CEO of Willett Advisors. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. As we come to the end of the week, we turn to our special contributor, Larry Summers, to really bring out some of the most important things of the week. Larry, welcome. It's great to have you back. I'm going to actually start with last week, if I may, because when you were on Wall Street Week, you said something at the Fed that a lot of people reacted to. They asked questions why that is. You said in their bond buying program, they are perversely, I think was the word you used, actually shifting us toward shorter-term funding structure when we should be going to longer-term funding structure. Could you connect those two things up for us?
Sure can. First idea, the Fed is a creature of the Treasury. The Treasury owns the Fed like the subsidiary of a company in a financial sense. What does the Fed do when it does quantitative easing? It puts out money, which carries a short-term floating interest rate as bank reserves, and it buys up long-term bonds. And so, in effect, the government now has a floating rate short-term liability outstanding rather than a long-term fixed interest rate liability, since the Fed is owned by the Treasury. At a moment of super uncertainty, at a moment when many people think rates are remarkably low, a decision to fund more short seems bizarre. And that's just one of the reasons why I think as quickly as we prudently can without destabilizing things, we should be bringing QE to an end.
At the same time, this week we found out that the government, at least part of the government, would like to borrow more money, as we had that $3.5 trillion budget resolution passed the Senate, now headed over to the House. As Congress looks at this, because there's a lot of steps to take before it actually gets made into law, what should they be thinking about? What should Congress be concerned about in terms of macroeconomic policy?
Look, the broad message of Bidenomics, of Build Back Better, that investment deficits are just as serious or more serious than financial deficits, and we have to address them, is right. But as we do it, we need to, one, pay for all the investments that we make with genuine revenue increases. Two, be very careful about locking in future liabilities that we don't pay for by, for example, funding very popular tax credits for just a few years. And three, making sure that what we call investments really are investments that augment the supply capacity of the economy. If we do those three things, this can be a contributor to non-inflationary growth and rising standards of living for years to come. But if we don't, there's a real risk that it's going to fuel an inflationary psychology and actually bring forward the date of the next bout of financial instability or recession.
So you have talked to me about inflation a fair amount. The Biden administration reportedly took some steps maybe to keep down at least the price of gas at the pump this week. Ironically, when they're trying to cut back on greenhouse gas emissions, they ask OPEC Plus to increase its production. What did you make of that as a matter of policy?
Look, I don't really hear the melody quite right on some of this. With Buy American, with raising tariffs, with various regulatory policies, with so-called worker-based trade policies, the goal of the Biden administration sometimes seems like it's to raise the price to consumers of most things, to help workers and to help businesses, and then to reduce the price of gasoline. Since we've seen this week that energy consumption is the most toxic form of consumption that households engage in, I think it's highly problematic to be trying to bring its price down while trying to bring every other price up. I think there's no more important price to increase in the American economy than the price of carbon-based fuels. And so this is a perverse kind of step from my point of view. I'd much rather see us do it in other ways than by helping OPEC. But in general, the right direction for gas prices is up, and the right direction for most other prices is down at a time of inflation, and policy seems to me in important respects to be pushing in the opposite direction.
Another important initiative of the Biden administration is the moratorium on evictions. And as we know, that lapsed from the Congress. They got the CDC to actually extend it now into early October. At the same time, it pushed the envelope a bit, I must say, on the law. Being a lawyer, reading the Supreme Court cases, it struck me it pushed the envelope.
I'm not a lawyer, so I can't judge that. It's clear from the press reports that essentially all the lawyers in the Biden administration had concluded that there was no real legal grounds here, and then they were able to find some rationale. It's frankly the kind of thing that Republican administrations have sometimes done with national security arguments, but this, on the press reports, looks like it's reaching a long distance. I understand about responding to emergencies, and there are certainly tragedies involved with evictions. But if you look at the overall picture, the picture is that household liquidity, household cash balances are at record high levels. Household debt service and even lower and middle income household debt service is at low levels. Other indicators of financial distress, like credit card delinquencies or car repossessions, are at relatively low levels. So I wonder this late in the process, in the midst of so rapid an economic recovery, whether an absolute eviction moratorium is necessary. And I wonder whether, if it is necessary, it shouldn't be legislated by Congress rather than called some kind of public health necessity from the CDC. I think the CDC would be better off focusing on getting us vaccinated, frankly, than on intervening in landlord-tenant issues.
Yeah, by the way, Larry, as I read this report, that's what basically they said. Come back when you've got some legislation here. Don't do this as a matter of executive order. But you mentioned vaccines. Let's go there, because you're part of a very important group, the Aspen Economic Strategy Group. They came up with a statement this week really calling on the U.S. to take a leadership position on vaccination. Tell us about that.
David, we're spending or proposing to spend $3.5 trillion on investing in the country's future. I cannot understand why we would not spend 1% of that at least on protecting the country's future with a forward defense investment in vaccinating the world. It protects against evolution that could be very damaging to us as we get variants beyond the Delta virus. It would be a huge source of American prestige and influence. Let's face it, our vaccines work much better than the Chinese vaccines. We're constantly talking about shoring up our alliances in concrete ways. There's no way more concrete for more countries than this. And it showcases what has been a huge success of American private sector, public sector collaboration.
So, Larry, I'm really curious because you've really led at very high levels in the U.S. government, including as Treasury Secretary. You have seen the intersection between politics on the one side and policy on the other. And there's a theme through what you've said today, I think. For example, in the pressure for lower gasoline prices at the pump. That's a political matter, I suspect, fundamentally. At the same time, leading around the world on vaccines, that doesn't resonate necessarily so well at home. How do you try to broker that deal between politics on the one hand, you can't ignore in Washington, and good policy that may not play that well politically?
You need to lead the people rather than follow the people. And that's what we did with the Marshall Plan. And we're going to need some of that, I believe with respect to what I think are the most important global security challenges, climate change and pandemic disease. And my reading of American history is that the American people respond to leadership when it comes.
That's so terribly helpful. Thank you, Larry Summers, our special contributor here at Wall Street Week, and of course, of Harvard University. Coming up, one more thought. Even the cutting-edge crypto world needs the old-school ways of K Street. This is Wall Street Week on Bloomberg. Finally, one more thought. Cryptocurrency meet K Street. The Gospel of Matthew warns that there's risk when you try to pour new wine into old bottles. And this week in Washington, we saw once again why. The new wine this time came in the form of cryptocurrency, that newfangled thing we aren't quite sure what it is. Is it a form of money? Is it a commodity? Is it an investment? Or is it just a way to speculate? Well, whatever it is, a lot of people are eager to get it and trade it, and yes, you better believe make money off of it. And if you make money, you have to pay taxes, right? And that's where the old part comes in. When the Senate needed to find a way to pay for some of that infrastructure bill, it seized on requiring brokers to report transactions in cryptocurrencies so the IRS can make sure people pay the taxes that they owe. But the cryptocurrency industry said they were going way too far.
The more education Coinbase and other members of the crypto industry do with lawmakers to help them understand the potential for crypto, the more we can shape the right regulation.
And so they did what industries have done since the middle of the 19th century. They lobbied. That time-honored tradition named for the lobby of the Willett Hotel on Pennsylvania Avenue, where all the real work got done way back in the Grant administration. And through their efforts, they got a bipartisan group of senators to come up with new language that the Biden administration could support.
It ensures that the bill does not sweep in software developers, crypto transaction validators, node operators, or other non-brokers.
Problem solved, right? Well, not so fast. It turns out that the arcane rules of the Senate give any single senator the right to stop the proposed changes. And Republican Senator Richard Shelby did just that, and he did it repeatedly, leaving the tougher language in the bill that actually passed. But don't despair. These blockchain upstarts are a pretty resourceful bunch, and maybe you can teach new dogs old tricks. Heck, maybe all it takes is for them to figure out how to get all those political PACs to take Bitcoin. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.